Okay, here we go. Hi everyone, it's Grant Abbott speaking, and welcome to my favourite tax and super strategies before and just after 30 June 2020. So it's all happening for us, isn't it, really? With COVID, lots of money going through. We've got our cash flow bonus. We've got lots of stuff going on. Certainly for accountants, it's been probably the busiest time of your lives. It'll be interesting to see what happens once all the JobKeeper and everything runs out, because I'm up at the Sunshine Coast and had a bit of a squiz around Maroochydore and Batinia the other day, and at least one out of every five, possibly one out of four, depending on where you were, businesses have been shuttered up for lease. So it's going to be interesting to see what happens once all the government's cash flow comes out. And of course, that brings down the reverse, is that tax is going to get so much harder. One of the things that is a bit disappointing is obviously the Div 7A stuff isn't out yet, but it still applies from supposedly the 1st of July, although we haven't seen the legislation yet, and also it's a bit scary with such much higher. Obviously, I think the interest rate's going to be up around at 7.94, which is, in this day and age, is just crazy. Anyway, let's move on. Tax time. Look, we haven't got a huge amount of time, but at least if I can give you a few ideas, some really helicopter level ideas, if you like them, you can do them quite easily on the LightYear doc site. So everything I talk about is up and running. So trust distribution minutes, absolutely crucial. Must get them in before 30 June, otherwise the trustee is taxed at 45% on the income in there. It's never been audited, but again, I remember getting a fortune cookie once and it said the law sometimes sleeps, but it never dies. So you just got to be really careful about that one. We've had a couple of questions around what happens with the cash flow bonus, because cash flow bonus is neither assessable nor is it exempt income. Next Tuesday at 12:30, I'll be sitting down with Michael Jeffries, who built our trust distribution document on the LightYear Docs platform, which is up and available for $99. It's a great system, absolutely crucial to get in before 30 June. I've just used it myself. So we'll be talking about how to cater for that cash flow bonus. And if you're going to turn up to that session, again, it's free. Make sure you bring your trustee along so you understand how it fits in. It may well be the fact that it can't be passed out of the fund anyway, out of the trust anyway. So we want to get up to speed. We'll, as I said, let's see you next Tuesday. Div 7A, look, our documentation covers a whole range, even distributions that going to, or loans potentially going to family trust. But as I said, there's those big changes that we'll put in the Treasury consultation paper, and it keeps on getting deferred. But they do supposedly apply from the 1st of July 2020. I know the Institute, the IPA, and also CPAs have all been tearing their hair out trying to get the government to move on it. So who knows whether it's going to be deferred another year, particularly with COVID up and around. So just watch out for that one and make sure you've got your Div 7As up and ready from the 1st of July next year. Now, if you're short of cash, so again, I'm going to talk about deductibles. I'm going to take you through the legislation, show you what a deductible contribution is, what the limits are on deductions, if there are any. We're going to be looking at contributions, suspense accounts rather than reserves. But the main thing is, for a lot of us, that particularly I think the year end is on the 30th of June, quite often we find that the transfers going through the banking system sometimes fail, which can create a lot of angst for our clients. One of the easiest ways around that is if you have a look at the Commissioner's ruling on contributions, which is 2009/1, I think it is, that talks about making a cash contribution and talks about the timing of when a contribution goes over or is deemed to go on over. One of the ones there, the Commissioner says that a short-term promissory note, and it's got to be short-term, otherwise it's going to be looked as a loan to the superannuation fund. A short-term promissory note is to be treated the same as a cheque or cash. So that you can do a promissory note up on the LightYear Docs site. That can be transferred over to the trustee, and it's deemed to be a contribution at the time the trustee receives that document. So again, as soon as it's signed, it's treated as received. So there's none of this banking finagling we have to worry about. So the promissory note can go in. Later stage, if the money comes in later, then what it can be used is to actually buy back that promissory note, so to speak, or cancel that promissory note. So again, if we have a look at it, a promissory note is absolutely crucial. Reverse side is also year-end pension payments, although there shouldn't be a big issue because obviously the pension payments covered in Section 7A of Part 2 of the SIS regulations effectively drop down. So there's a 50% reduction. So as a consequence of that, most of your clients should be in a position of effectively made their minimum pension payments. But if they haven't, if there's an issue, then what you can do is, if they haven't got the cash inside the fund, if it's all in shares, if you utilise all their cash, then you can actually pay a promissory note. So this time the promissory note goes from the trustee of the superannuation fund down to the member. If you're not using our account-based pension pack, you'll find with LightYear Docs, we've got a lot of add-ons because we've got a strategy automation system as opposed to just applying templates, which you get everywhere else. You can actually tick a box there that is embedded into the contract or the account-based pension contract, which is effectively a contract between the member and the trustee of the fund, that if there is any shortfall in any pension income year, then there's deemed to be a promissory note which has been issued by the trustee of the fund to the member. So again, it's got to be a short-term nature, but that's embedded in the documentation. The same thing as well, what we've got to do is, it's not a bad idea now with minimum pensions, it's even better, because particularly for some of you who've got clients who've got retirement or got accumulation accounts and pension accounts because they're over their T-bar, that when they do take money out of the fund, that anything over and above the minimum pension is to be treated as a commutation payment. Again, there's another button that sits in the LightYear Docs account-based pension pack. You tick that, and then effectively all amounts over and above the minimum pension are treated as a commutation. Now that's important because a pension payment has no impact on T-bar, whereas a commutation payment actually will go to debit against the member's T-bar account, which once you get a bit of a head of steam up, whether it's $100 or $200 or $300,000, a commutation or that debit, you can then transfer some of the money from the accumulation account into the pension account. So just watch out those ones. We've got to make sure your documentation allows it. And if you haven't got one of the account-based pensions from LightYear Docs, quite easy to go in and put in a new place, just do a rollback and then start up a brand new pension that has got those minimum pension payments and the commutation payments that have an impact on the transfer balance. With the TRIS, obviously, for those of you who got TRISs for your clients, look, I'm not sure. It's just a pain in the neck now. We don't have pension exemptions, so that it sort of sits inside the superannuation fund and the accumulation account, starts up or is sitting around there like a festering sore thumb. You take out your 10% or whatever you need, and then it just carries on from year to year. The TRIS should be closed. In fact, you can go onto the LightYear Docs site and do a foldback, and a foldback means simply that TRIS is closed, and you might as well just clean it up at 30 June. Importantly, from that perspective, if you need it again next year, start it up. We went through the last couple of weeks on Tuesdays at 11 o'clock. We've just introduced a new session for our LightYear Docs users. It's a very exclusive session. It's for our subscribers and also our licensees. There's no cost for the session, but I sit down with maybe 15 or 20. We do a strategy round table. This week or last week we looked at temporary incapacity. This week we looked at permanent incapacity. Next week I'm actually going to look at an advisor sent me in a couple of wills, and I'll be going through and actually building those wills on the site and covering the issues that you really need to be looked at. So it's quite important to have a look at that. But the context there is we did pull apart the definition of retirement under 1.067 6.017 of the SIS regulations, and retirement there, which we then had a look at an APRA guideline and also the tax office website. Retirement there is once you've reached age 60, you've given up one form of gainful employment. For example, if you're a doctor and you've got a full-time work and you're a locum at a hospital, once you give up that locum position, that effectively you're deemed to be retired even though you carry on work, which means at that point in time, all of your benefits are effectively transferred to unrestricted non-preserved, or what we, for the short term, we call it unpreserved. Any future SGC and other contributions or salary sacrifice going in, they will continue to be preserved, but anything that's in the account at the time that we're retired at age 60 is the best. So for tresses, you shouldn't have a tress post age 60 is crazy. You need to get a client in, get them out working for a short period of time, cease working, you met that conditional release because they've given up gainful employment post age 60, and then essentially you're off and running. For those who, because I think tress now applies a minimum, or the preservation age is 58, so just bear in mind next year if a client is short on cash, you can do multiple tresses in a year. So each time you do a tress, effectively you can withdraw an additional 10%. So just be careful of that one. For typical tax strategies, bucket company. So if you go in the bucket company, but at the end of the day, with a bucket company, someone's going to have to pay the piper at some point in time. And you don't want all that cash to be locked up into that bucket company with franking credits. It's not a bad idea. Quite often, it's not a bad idea, particularly if there's potential exposure for litigation or creditors, probably not so much creditors, litigation or family provisions claims. If the client dies, you may want to use the protector, which is a gift loan back strategy, and transfer the equity in that in those shares into a family protection trust. Remember the one that we set up this morning. Another one you can do is, and it's not used very often, but this is where you've got a lot of money coming through the system, is to distribute directly down into a self-managed superannuation fund. Generally, it wouldn't be treated as a contribution because it's just the same as any distributions treated as income in the fund. It's actually treated as daily income, so it's going to be taxed at 45%. So there's a little bit of a tax saving there. But inside the fund, it would just be treating as earnings of the fund rather than a contribution. So to be split proportionally amongst all the members of the fund. So have a look at that. That's not a bad little one. Not used that often because more often than not, most people prefer to get the bucket company and get the lower tax rate of 30%. Prepayments, obviously, get them to prepay your fees, which is not a bad idea. Deferring income, it's not a bad idea, but deferring income may have an impact on JobKeeper and, of course, the instant asset write-off. Okay, let's go to super contribution laws. First one is the $10,000 withdrawal. We actually had a look at this yesterday when I was doing, Tuesday, when I did my strategy round table. Ordinarily, if you can access your superannuation and you're under preservation age, then the taxable component is taxed at a flat rate of 20%. Whereas for this one, the $10,000 withdrawal, which virtually I believe everyone except those in SMSF should withdraw the $10,000, even if you put it back later on, it's not a bad idea because it's going to go back in as tax-free component, which is of a huge benefit later on. So when you do withdraw it out, it's actually not assessable. So it's neither assessable nor is exempt income. So it's the best time. Not only can you get access to your super, but when it comes out, it's completely tax-free. So we can get in up to 30 June, and there's 2.1 million people who have accessed that tax-free component coming down. I think the average withdrawal's been around about 7,000. And then we've got from 1st of July up to the 26th of September. Likewise, there can be another contribution there. The commissioner is, because a number of people have been, I don't necessarily advocate it, so I'd like to see it, but a number of people have been withdrawing the money and then putting back in as I said it could be tax-free, but they're not putting in as a non-concessional, they're putting back in as a tax-deductible contribution. And the commissioner has just said that he's going to address that issue a little bit later on, but no doubt he'll probably address that post 30 June once it's too late to put it back in anyway. With the super contribution laws, likewise, we don't have to do it by way of an employer contribution. One of the ones that is quite important, particularly if you've got your discretionary trust or your family trust, is that an individual can be employed through that family trust, and the amount of salary sacrifice they can take isn't commensurate with the amount of work done. So there's been a couple of cases on that and even ATO rulings on it. So that when we pass that money out, it would be tax deductible to the family trust, and obviously it's going to be assessable in the hands of the trustee of the superannuation fund, which we'll look at shortly. The alternative is, and we've still got that option, we can distribute directly down to the individuals, and then they can contribute into the superannuation fund. Now, if you're going to do that, if you're looking at the distribution and it's going to be at 30 June, obviously you have to have your trust distribution minutes. You might not have the cash, so that may be where there's a good promissory note which is issued by the trustee of the family trust to the individual, who can then transfer that promissory note into the trustee of the superannuation fund. Will now hold the promissory note which is owed by the trustee of the family trust, who, when receives cash, can then transfer that over into the superannuation fund. So again, what we'll need to do is, before we lodge the tax return, we'll have to issue a notice that we're making a tax deductible contribution in relation to that. But again, that's not a bad one. And the older we are, essentially, the better it is. And I'm going to come back and have a look at that a little bit later on. It's even better than the bucket company. Now, the only other thing that I would say on that, particularly for the younger crew, is that if you go down that track, then the contributions coming from the individual into the superannuation fund, as I said before, they're effectively treated as member-directed contributions under Part 5 of the SIS regs, and they're caught as minimum benefits in the fund, which means they can't be accessed unless you've met a condition of release. And perfect condition of release is the $10,000 withdrawal. However, if it was an employment, so if the individual was employed, let's say the 35-year-old, they're employed on a package of $50,000, they did a full salary sacrifice, they didn't need the money, then going in there, the SGC on the $50,000 package of $4,500, that's still, they call mandated employer contributions. So they're preserved for minimum benefit standards, or protected for minimum benefit standards, but over and above that, the remaining $45,500, they're not member directed because they've come from the employer. They're salary sacrifice. So in our accounts, we should treat them as non-member directed contributions and non-SGC or non-mandated employer. So that means if our member becomes incapacitated, they're simply off work for a week or two or 3 or 4 months, they can then use that as a pool in order to receive a temporary incapacity income stream, which is essentially just like self-insurance inside the fund, and effectively you can pay out whatever salary or earnings you're receiving before that temporary incapacity. Beautiful thing about that, it's still assessable. It's just like salary continuance, but the fund will get a tax deduction for a portion of those payments. So the little difference there is between being employed and salary sacrifice, as opposed to bringing it down as an individual and paying it out. So again, that's just a little trap for players. Transferring shares into an SMSF, again, it's not a bad idea. I'm going to look at that a little bit later on, using those personal contributions to offset CGT. So I've got a case study for us a little bit later on, but certainly we've got until 30 June to do that. And you just need to do an off-market transfer if you need be. I do have some really good share sale agreements. In fact, I worked on one with one of our advisors, Mike Hickman, who we did a share installment purchase agreement between the SMSF and the individual. So the shares would be transferred over a number of years, and those purchase price would be treated as contributions. So that's not a bad other one to do. Now, as I said, employer contributions, don't forget to employ children and also parents as well. And we'll go through and have a look at the legislation around that. So the key ones there for making the contributions, so what we need to do is we need to look at what's allowable under the SIS Act and SIS regs. And then what we need to do is then have a look at the taxability and the tax consequences of those ones. So SIS Regulation 7.04, until 30 June 2020, there's no work test for any contributing member. So if you're up until next week or Tuesday week, effectively what we've got there is there's no work test there. From the 1st of July 2020, that's now going to be shifted out until age 67, which is also going to have an interesting impact on that one, because the 3-year bring forward rule applies where you're age 64, as long as it's before your 65th birthday. And likewise, we'll be able to do the same thing with 67. So those that 3-year rule will have quite a significant impact on us, which will be absolutely useful. After that age, in fact, it's not even 40 hours of gainful employment. We had a look at if you're part-time gainfully employed. So this was the old rule. Again, they change the rules all the time. And I only picked this up yesterday on Tuesday, part of that permanent capacity strategy roundtable. Someone asked me about self-employed contributions post age 70, and we deep dived into the legislation. And they've gone ahead and changed 7.04. So the prior rule, we had to do 40 hours of gainful employment over a 30-day period, is gone. You just simply have to show that you're engaged in part-time gainful employment or self-employment, which is just simply 10 hours per week. Now, I'd probably go above 1 week, maybe do a couple of weeks there. But again, once you've done that in any income year, then you can contribute during that year. Obviously, there's there's caps there that we have to look at, but essentially what we can do is we can make those sort of contributions. So when we have a look at the super contribution laws, so what I've done is I've just moved from the SIS regulations, which basically is saying, look, if you're under age 65, you can make it. 67 starts from next year. And then just bearing in mind, once you're between 67 and age 75, then you've just got to be engaged in part-time gainful employment during that year in order to make a contribution. So it doesn't have to be the same time making a contribution, just in that year. Now, the question is whether it's deductible. So section 290-60, I've just pulled down the contribution rules for us. So we're now moving into the tax side. It says, you can deduct a contribution you make to a superannuation fund for the purpose of providing super benefits for another person who's your employee when the contribution is made. And don't worry about this one, regardless of whether it relates to whether they're deaf or not. So employers, any contribution they make to a fund is immediately deductible. And so there are no caps for deductibility of contributions. The cap side fits basically at the individual level or the member level. So employers can make as much contribution as they want. If an employer, when we talked about that salary sacrifice, if a client has got a $300,000 bonus coming to them and their employment agreement allows them to salary sacrifice, there we go, Gordon Black, thank you very much for this one. So where a member makes $300,000 bring forward contribution prior to their 61st birthday, are they prohibited from making contribution the following 2 years, assuming they make the work test? Let me take that on and just work my way through it in terms of that new 67 rule, which I'm assuming that you're relating to, Gordon. So leave that with me because obviously that's going to have quite a significant change with the 67. So really good question, Gordon. Leave that with me and I'll come back to you on that one. Again, once you start to put a new legislation over another one and changes are made, everything starts to pop up. So again, if we had an employer making a contribution, so Gordon was just talking about the non-concessional contributions, but an employer, if you've got a bonus of $300,000 can make, you could do full salary sacrifice for it this year if you wanted to do that, and going into the superannuation fund, and the employer would get the tax deduction. Probably doesn't work, well, it probably does work in some instances. I was going to say with real estate agents, it's probably not this year, there's going to be a big commission structure, but for some, certainly for some businesses, they've done quite well. So making that large contribution at year end is worthwhile, and you suss it out compared to where the bucket company is, or importantly employ parents who are up to age 75. The good thing about that is if they're over 60, they're retired, then they can take the money out straight away. And obviously when it does come out, it's tax free. So there's a lot of opportunities there. You can see on the right-hand side, section 290-150, which is your personal contributions. Bearing in mind, you do have to make sure you lodge your notice with the trustee of the fund that you are claiming a tax deduction, or the amount that's going to be a deduction. But essentially, you can deduct a contribution you make to a super fund for the purpose of providing super benefits for yourself. So remember, the one on the right-hand side is a member-directed contribution. Remember how that's impacted for temporary incapacity purposes, whereas the one on the left is salary sacrifice. So the SGC is mandated employer, but anything over and above that we can access down the track if we are temporarily incapacitated. So if we're sick with a bit of man flu and that sort of stuff, so watch out, or a good hangover. I'm doing St. Finny's the sleep out tonight, so I'm not looking forward to that at all. So I might be accessing my temporary incapacity benefits tomorrow. So what we've got now is we're looking at, we've made the contributions into the fund, and I'm going to bring this around. We're going to have a look at a case study very shortly, so it'll all becomes very apparent. Now, concessional contributions on the left-hand side, section 291(15). So again, the best thing to do is, rather than listen to me, is if we do a deep dive into the legislation, then we're all fairly confident of what's going on. And as you can see, the words are pretty easy. So if you have excess concessional contributions for a financial year, now bear in mind that compared to this, you can see with the employer contributions, they're all deductible. So it's got nothing to do with caps. So what happens is the responsibility goes to the individuals. So you can see if you have excess concessional contributions for a financial year, an amount equal to the excess concessional contributions is including your assessable income for your corresponding income year, and you're entitled to a tax offset for that income year equal to 15% of the excess concessional contributions. So let me just play around with you on that one. So we've got a client who's got a family trust. It could be a rural family trust, any family trust. They've got a bit of income that's coming through that family trust. So they employ their dad, does the general admin duties or the dog's body or does whatever they do. And as a consequence of that, they make a payment of $75,000 over into the family superannuation fund. So it goes over the superannuation fund. The family trust gets a tax deduction of $75,000 for that. How do I know that? Well, section 290-60 says it will get a tax deduction for it. For minimum benefits, probably not an issue. I mean, if they're over age 60, it's all not unrestricted, non-preserved. That new contribution, if we've given up one form of gainful employment and they're under age 65, then we have to meet another conditional release. But if they're, say, 70 years of age, there's no drama about that. Now, what will happen is if they've put in $75,000 contribution is tax deductible, then what will happen there is there's a $25,000 cap. So the excess concessional contribution for our father during that year is going to be $50,000. Does that make sense? So it's going to be $50,000 or 75 less the 25 cap, and then it's going to be $50,000. So on $50,000, we've got to work out our tax rate, and obviously we've got our tax-free threshold. We have our low income tax offset and a low middle income tax offset, and we work out our tax payable on that. At the same time, what I have to do is I have to get a Grant's trusty calculator, $50,000 times 0.15, and I'd end up with a $7,500 tax offset. Can you see that in 291-15 subsection B? Now, I've done this in the past, and on $75,000, if there's no other assessable income because Dad's living off his superannuation earnings, superannuation pension income or lump sums, which are all tax-free over age 60, then once we add it all back, because both of those amounts are neither exempt or nor assessable income, so once we add that $50,000 back, I think the tax rate is around about $7,230, if I remember correctly, whereas we've got a tax offset of $7,500. So in that instance, we're in a pretty good position because making that tax deductible contribution, there won't be any tax payable in the individual's hands. Now, of course, we've got to look at it a bit later on because I've just made a $75,000 contribution, which will be assessable or will be a taxable contribution to the fund. Now, non-concessional is a little bit different. So the amount including your assessable income, you're entitled to a tax offset. Again, it's along this sort of process is if your non-concessional contributions exceed an index cap, so that's $100,000 or the $300,000 that Gordon was talking about, but I'm going to have to work my way around between 65 and 67. you're not liable to pay excess non-concessional contributions tax for the financial year on the full amount of the excess. The amount including your assessable income relates to your associated earnings on those excess contributions and any amounts that have been released from your superannuation interest. So again, with that, if you aren't over your cap, then effectively what happens is if it's over the cap but you don't have to release it, then you bring back those associated earnings and there also get a tax offset as well. Now, mind you, remember I did the $75,000 contribution, that $50,000 of excess concessional is classified as non-concessional and is to be added into my caps at that stage. So non-concessional contributions, 3-year rule. As I said before, I think we all know this anyway, that if we're before 65, we can do the 3-year. From 1st of July 2020, then it goes up to 67. So it will be interesting, for example, if we do it at 65, what will happen at age 67. So I'm just going to have to watch on that one, because that doesn't mean if we do it at age 64, that 3-year bring forward rule, which normally would cover me up to 64, 65, 67, does that preclude me from doing it again at age 67? So I'll come back to you on that one, Gordon. Very apt and very poignant for this current financial year. Now, as I said before, super contributions accessible to the fund. So 295/160, section 295 is all the taxation side of the fund, deductions, exempt income, so on and so forth. So section 295/160 says the assessable income of an entity includes contributions or payments as set out in this table. So there's, I think there's about 8 or 9 items, but really the main one for us here is into a complying SMSF. So assessable income of this entity includes contributions provide super benefits for someone else. And then there's another one, obviously, if you put contributions for yourself and you claimed a deduction or you've claimed a notice. So in essence, where we've got that, remember I had that $75,000 contribution in relation to the father from the family trust, then the whole $75,000 would be treated as assessable inside the superannuation fund. From that, obviously, we need to get imputation credits, we need to get tax deductions, so on and so forth. So that's how that plays out from there. The final one that we can also use that I want to just draw to your attention, particularly now that we're in June, is SIS Regulation 7.08. So I'm back in the SIS regulations. The tax I've already covered, deductibility and accessibility, and everything has to be made. So, for example, if I put in a contribution, flicked it over to the trustee of my self-managed super fund, came from my employer account, which is, let's say it's from Westpac, is to go over to my NAB account, which is my superannuation fund account, and that doesn't hit until Wednesday, the 1st of July, then I won't be able to claim a deduction for that year because it hasn't been made. Promissory notes, as soon as you get it, give it to your trustee who's one and the same, then it's to be treated and made at that time. And then obviously the accessibility is then carried into the next year. But we essentially want to make sure that we're getting everything deductible this year, and obviously it's all going to be accessible in the fund. Now, what we can do though, and this relates back to these excess issues here. So when I come around here, here we go. So when I have a look at the excess, it says if you have excess concessional contribution for a financial year, an amount equal to the excess concessional contribution, including your assessable income for your corresponding income year. So, for example, what I can do is, let me just play around. So I could, if I wanted to, I could put in, let's say I've got $50,000. So I've got a bit of a contribution up. So my employer puts in $50,000 of contributions into my super fund this year, which is fully deductible. Likewise, it's fully accessible to the fund. Does that make sense? Does everyone understand that one? Now, $25,000 is my cap. So prima facie, without doing anything, it looks as though $25,000 is going to be excess concessional, which will be then added back to my assessable income for the year. If I'm at a 30% rate, then what will happen is the tax will be 30%, but I get a 15% tax offset. So the maximum tax I pay is 15%. And it's on the basis that obviously there's been 15% tax deemed to be inside the fund. Now, what I can do is I could actually put that contribution going in. So $25,000 from an accounting perspective, $25,000 goes into the member's account, and then $25,000 goes into a suspense account. So it's not allocated to member, it goes into a suspense account. Likewise, remember I did 75, I could go 25 now and $50,000 into a suspense account. So what happens there? Well, under Regulation 7.08, it says this regulation applies to the trustee of the regulated superannuation fund if the trustee receives a contribution in a month. So that is, for example, in June here, and don't worry about 7H and 7G. The trustee is not required to allocate the contribution in accordance with 292-170.03, then, which is the case. Then 2, for subsection 31 of the Act, the trustee must allocate the contribution to a member of the fund. These are basically defined benefit contributions, so we don't worry about that. We're in 2. Not later than 28 days after the end of the month, or as soon as it's reasonably practicable. So to do a contribution suspense account doesn't make sense. If I'm going to do it December, I could put that, remember that $50,000 in, $25,000 is credited in December. I can put $25,000 into a suspense account. That will then has to be allocated to the member's account in January. So that doesn't make sense. But if I do it in June, then what I can do is $25,000 goes in now, it's credited to the member's account, $25,000 to suspense, and then by the 28th of July, or as soon as practical thereafter, I'll have to allocate it from the contribution suspense account down into that member's account. So what's happened is I've transferred that contribution into the following year. I've got the tax deduction in the year ending 30 June 2020, but now it goes over to the following year. And if that's the only contribution that's made during that year, then I go through the assessment again. So what I'm doing now is I'm working out my excess concessional for the year ending 30 June 2021. If that's the only amount, because that's when it's received, I don't have any excess concessional. Is that following? Compare that to, remember though, I had 25 and I put 50 into a suspense account. Then what would happen is next year, 25 is my concessional contribution. It's all concessional, but I will have 25, which is excess. So I'm then going to have to add that $25,000 back to my year ending 30 June 2021. And then that will obviously have a tax offset there. So you can play around with these numbers quite a bit. So let's go and have a look a little bit further on that one. So that's a contribution suspense account. Again, you can do that straight off the LightYear doc site. In fact, if it's an employer, you can bundle like 2 or 3 employees if need be, and then make an allocation a little bit later on. So let's have a look at some pre-30 June. As I said, concessional contributions do not have a cap. There's a threshold, so you can really pump in quite a bit there. I do have a strategist article which shows, how we can do quite a bit with the $75,000 and pay only $300. That was before the low middle income tax offset, so there is no tax payable. Non-concessional, watch that at age 67, and contribution suspense accounts. Okay, so we want to have a look inside the fund. So the fund has got $75,000 of assessable income, tax payable on that, prima facie. Let's get my old trusty, there goes 111, get my trusty calculator out. And on $75,000, I'm sure you've already got this, $75,000 is $11,000 of tax payable. So we could put in a bit of money, obviously, to get franking credits into an imputation fund, prepay some of your fees, which would reduce the that $75,000. Do prepay any expenses if that's possible. Alternatively, look at a SIS company where you get a 20% tax write-off. So if you put in probably around about, if it's $75,000, if you put in around about $55,000, that would get rid of the tax liability there. And then look at upgrading client deeds, etc. That's another good strategy for you guys. So let's have a look at a case study here. The client's 65 years old, retired, with an 800K share portfolio outside of their SMSF. So it's got 400K in capital gains, so there's 200K assessable. Remember, we looked at this early this year. not a bad idea for clients, particularly where we are at the moment with the market gone down a little bit. So therefore our capital gains have been reduced to some extent. Transferring those into our superannuation fund and working out how we can reduce our capital gains. So the big one here is 200K assessable. So this is what we do. We transfer all the shares into the fund. So we do that by way of an off-market transfer. Obviously, what we need to do from that perspective is we want to make sure that that off-market transfer is completed before 30 June. And the timing of the contribution is when those shares are registered. So just be very careful about that one. So what we've done there is we've put in 800K into the fund. And what we're doing is we're going to claim a 200K concessional contribution this year. So of the 800K, it goes into the fund. We've got 400K capital gains, 200K of assessable. We're just going to have to watch out on that one for our non-concessional caps, of course. And I'll come back and have a look at that shortly, because we know that we can only get 300. Again, I'm in that magic age anyway, so I'm just going to have to be really careful about that, and I'll have to look at Gordon's question a little bit later on. So we contribute the 200K this year, so there's no tax in the current income year. So the current concessional for this year is $75,000. So remember, I took it back to zero. So what I'm going to do is going to put $75,000 straight into the member's account. The other $125,000 I'm going to flip up into a contribution suspense account and land that into next year. Now, the 125 that goes in, 25 is going to be part of my cap next year, and 100 will now be fully accessible to me. But remember, I'll get a 15% tax offset. But that all relates to next year. So effectively, from that perspective, what it means is we're going to be in a position that it's going to carry over to the next income year, and it's going to be 3rd June 2021. So by the time I lodge my return, which will probably be April 2022, that's when all that excess concessional is going to have a look at. Now, we put in 200K of concessional. We need a relief because that's $30,000. So if you put of that, if you did a bit of an adjustment of share portfolio and put 150K into an ESIC as a sophisticated investor, then that 30K will effectively go straight away. So again, just be very careful on that one. 100K is in this year's non-concessional, but we've got 50K from the excess concessional. So what we've got there is effectively 50K for the excess concessional. Remember, we've taken this year, and that's a non-concessional. So of the amount that goes in, we've then got 50K. And so what we would do is we've then got 200K that we've got there. So we've got $75,000, and then we've got another 50K. So 125,000K would be included this year. Everything else then goes into a suspense account. Now, when we come down to it a little bit later on, we're going to have to work it out. Now, as I said, they're 800K portfolio. They're not in pension yet, so you'll start a pension virtually shortly thereafter. What we do is, as I said, the contribution suspense of 125K we've got there. We've got our NCC, because I'm dropping it in a suspense account. I start next year, I'll have that 3-year bring forward. Again, the benefit of that is I've got the that 3-year window that can apply from my perspective, starting from age 66 and 67. Now, what we're going to have to do is do the numbers, and I've just sort of talked around the broad aspects of it. But what we can do is we can work out the numbers exactly. But to the extent that we work out our concessional, our non-concessional, so we don't go over those caps, anything left over, and I've worked out it's around about 350K. Anything left over, we do a related party loan under PCG 2016/5, which requires a set of super trustee minutes, a holding trust minutes, a related party loan, and a mortgage deed. And you can do that. That's all automated on the LightYear Docs site. So what we can do is we can actually build a nice little strategy there to get our shares over in one hit. And the beautiful thing about that is that then we've got $800,000 of shares are out there working for us with imputation of credits, so on and so forth, right from day one. We want to obviously drop down our suspense account right from the start. So you can tweak for it. So if the shares are held jointly in a couple, then basically you're probably not going to need to do the loan at all, because we'll actually be able to flick it out for both of those. Alternatively, if we've got 1.6 million jointly, then we can do the same for both of those clients. If the clients are under age 55, generally we go down the tax deductibility, but with a non-concessional, I sort of leave that as the last bit. What I want to do is find out how much I can borrow, how much I can lend by the individual, because what is the related party loan by doing the transfer, and I can do a 50% related party loan under the Commission's PCG 2016/5 Safe Harbour rules. And if I do that, the beautiful thing about that is that under age 55, in fact, it's under preservation age, it always means that we can then, whatever that related party loan is, I can always pull that out or get that loan repaid from my superannuation fund. So again, it's not a bad little strategy there, because we're still accessing that. And then we work that out, and we work out access concessional or concessional contributions, and then anything over we would then use as non-concessional as well. So start with a related party and the tax deductibility of it as well, which is important. In-house assets, just be careful. You can transfer in-house assets into the superannuation fund, but you just got to be careful. It's only up to the 5% level. And by that, I mean shares in a private company can be transferred in. You've got to watch out for the 5% level, but under Section 66, if they're in-house assets, you can be transferred. But if you've got $1 million fund, that's only going to be $50,000 of shares. But it's still not a bad idea if you haven't got a cashola to transfer some private company shares in as well. And as I said, commence a pension in early July once the contribution allocated. You've got that, you've got imputation credits. Look, it's a much better deal than having those shares outside the fund. Plus, there's also asset protection, and you can use it for an SMSF death benefits trust at a later stage. So I've ripped through that pretty quickly. In fact, I'm probably about 5 minutes ahead of time, which isn't a bad idea. What I want to do is I'll just go through, as I said, we've got those weekly strategy workshops. What I want to do is I just want to show you where we're going, Eventbrite. So on 13th to 14th of May, I want to give you a really good deal on this one when it comes up. So we've got a virtual strategy summit. I think I'll just reboot this. I think it's changed a little bit. We keep on adding a whole lot of new speakers for that. So it's an online event. Starts at 9 a.m. on Tuesday, the 14th of July, finishes at 4 p.m. I'll go through this. We've got Andrew Inwood talking about, he's absolutely brilliant, where we're going to with COVID, economics, etc. Tim Munro and myself, we're going to really smash out some, starting the year on tax strategies. That's from 9:45 to 11. We're going to look at SMSF licensing. We've got David Moss, myself. I've got Amanda Cassar, George Haramis, and hopefully Andrew Conway on that, and looking at what's happening with SMSF licensing and also the accountant's exemption. More importantly, can an accountant do an investment strategy? What can an accountant do? If a client comes and says, I want a self-managed super fund, what can I do on that one? Can you set it up without being licensed? So we'll look at that. We've got a senior person for the ATO who's going to be covering all the COVID measures, and particularly some of those, the early release, and some of the issues around their compliance. Look away, or remember they've said that they're basically not going to look at the compliance side. Flow of capital, where's the money going in, where's it out? So looking at SMSFs, industry, retail funds, and the money out there to look at where, if your client needs capital, where's the best place to look for that? New loans and fintech related party loans. We've got Judo Bank, eMoney and Oak Capital, all going to be looking at, these are all second players on what to look at. Automation, artificial intelligence, 60% or 53% of financial services jobs are going to go by 2030 thanks to automation, artificial intelligence. We've got Ash Jarman from LightYear Docs who looks at ours, Ron Lesh from BGL, a couple other players. So that's going to be a really interesting session to see where we're going. And particularly now we've got COVID. We're going to look at marketing strategies as well. We've got fantastic Ryan Gambit, who's absolutely brilliant, who's going to look at fitness and body. And then we've got a cocktail session from 5 to 6. We're going to be doing virtual cocktails. We're sending out a lot of cocktail recipes for that. So we'll be doing those at a session. Day 2, new estate planning and living wills, which is a great thing overseas. I've been carrying that out, and also Tony Ellis from Abbott-Family lawyers, and we've got another estate planning lawyer coming in for that one. So that'll be the latest strategies for estate planning, and more importantly, forgetting about doing estate planning, doing a living will. So setting up a family protection trust before you die to ensure there's no family provisions claim. We've got Suzanne Bransgrove, who's really good at building family structures, building structures for family businesses and succession in there. So that's a good session. Asset risk protection and liquidation. We're going to be looking at gift loan back strategies, and Michael Jeffries and Rodney Peters on how to, particularly now that we're coming out of COVID, how to work with creditors and minimise your payments. And these guys have done some absolutely amazing things. Property development and property investment. We're going to be looking at, with Brent Backhouse, I'll show even at our firm Abbott-Family, for in the last 3 years, we've done more than $1 billion in property development through SMSF. So it's a great thing to go through. We'll go through all our strategies and ideas on that one. Work, now that COVID has virtually made everything, I suppose, people are working at home. In fact, people are preferring to work at home. There's been some great studies on that. Question is, do we let them continue to work at home? Obviously, there's a huge expense saving there. Or do we, in fact, start to looking at offshoring to places like the Philippines or India or wherever? And we've got a couple of expert people from offshoring and also building in-house. Best ever technology stack. So we're looking at Tim Munro, Michael Jeffries, James Beresford of Practice Protect, Ethan Cooney from Practice Ignition, Warren Rendon from BGL. We're actually going to be bringing together what the best technology stack is, and then we've got a strategy roundtable at the end of that. So with the tickets, what we've got there's 11 hours of CPD. At the moment, the early bird is $199. If you are an LYD user or you're a registered user, then you can contact us at support@lightyeardocs.com.au, so lightyeardocs.com.au, and you get a free ticket. If you do want to get CPD, those 11 hours, then it's only $99. And that's our administrative cost of running our CPD operation and paying for all the relevant fees. So if you want to get those discounted fees, and that's not bad, 2 days of excellent speakers, and we're adding new speakers every day for $99. So it's brilliant, and look, it's going to be a great session. Anyway, that's enough. I haven't got any further questions. What I'll do is I'll record. This is being recorded. I'll put this up on the site, and then I'll send it out to you very shortly with a couple more details. So watch out for this later this afternoon. Anyway, it's Grant Abbott signing off. Thanks for your attendance today. And it's great. Thank you again, Simon. It's great to see you.